following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
That music, that zesty, newsy theme means it's time yet again for Volatility Views. My name is Mark Longo from the OptionsInsider.com, as well as the ever-expanding Options Insider Radio Network. And I am joined today on the Volatility Views program by quite the motley panel of contributors, starting off with the yin to my yang, none other than Mr. Don Schlesinger himself from the Volatility Exchange. Don, welcome back to the show, sir.
Thank you. Looking forward to today's discussion. Always a pleasure.
Don, you sound so enthused. I can feel the enthusiasm dripping off you as we speak.
Yeah, doesn't he sound like he's just super happy to be here? Unbelievable.
All right, and listeners, that grumbling voice you hear in the background is none other than the Seabass, a.k.a. the Slinky, a.k.a. the man from the pits, Mr. Mark Sebastian from OptionPit.com. Mr. Sebastian, welcome back to the program to you as well.
Oh, well, thank you for having me, Mark. You know, this is kind of my one moment of peace every week where I get to listen to the melodic sound of Don Schlesinger talking about volatility and, of course, your deep baritone vibes as well. And now we've got Schwartzy on the call as well. This is kind of going to be the best thing ever. This is going to be like This is going to be like Sunday with America's Funniest Home Videos for me. That's how great it's going to be.
Yes, the epic days of the VHS tapes on America's Funniest Home Videos. That might be a new tagline for this show. Vol Views, your moment of peace and serenity in a chaotic world. There we go.
There you go.
I love it.
It's the non-volatile part of a volatile world.
Kind of sad when this is the highlight of his week, huh?
Well,
oh, Don, don't sell yourself short. You're like the man. You're like the greatest guy ever. You know.
I think Henry's already regretting being here, right?
Oh,
I'm happy to join you guys and talk ball.
And that voice, listeners, is our guest for this week. We are diving into the practitioner route and taking a break from the world of academia for a while because we want to debate a very heady subject on the show today. And so we wanted the man with the plan, the man with the data to come and help us discuss that topic. Of course, he is Henry Schwartz, the founder and CEO of Trade Alert. Henry, well, first off, welcome to Volatility Views.
Thank you. This is new for me.
Yes, you've been on the network in various capacities previously, but this is your first appearance, I believe, on Volatility Views. And since it has been a while since you've been on the network in general, why don't we kick you off? You know the drill. Give our listeners a bit of your recent overview, your recent history in the derivatives world, as well as what you folks do over there at Trade Alert.
Sure. My way back in the olden days, I was on the CBOE floor, then the Amex floor, and then trading in Europe for a bit, then moved to the upstairs world at Solomon Brothers, traded indexes. I don't think VIX actually existed until I was done trading indexes, but I had plenty of experience making and losing money with volatility positions, so I definitely have some practical experience there. And then for the last 6 years now, which is a really long time, I've been running Trade Alert, which provides very specific alerts to options professionals for significant trades and unusual activity and kind of all the juicy stuff that goes on in the market. We try to cut through all the the crud and kind of really focus in on the things that matter for people. So so I'm happy to be here. Thanks.
All right, and with the team assembled, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we discuss the week's worth of action in volatility. And I think this week we're going to mix it up a little bit. We're going to shake it up in honor of Henry's presence and coming on the full show with us. We're going to go a little crazy and make our listeners less complacent. So we're going to start off this week actually diving into the realm of Euro Vol. Don, can you handle that? Can you handle that massive shift in the programming?
I think we'll be able to put up with the curveball, right?
All right. So, Don, what have you been watching in the land of Euro Vol?
Well, we mentioned last week that it was an expiration for the front month February contract, and that we had discussed that phenomenon of rising euro price, but with not a great deal of volatility. In other words, an orderly rise that was reminiscent of what often happens in the equity markets. When we have up markets, we often see depressed volatility. So that front month one vol settled at 966, first time in a while that we had single digit for the front number. And then we looked ahead to the March contract and noted that the first pricing that we were seeing was all the way up in the 11s, 1136, reflecting, of course, the full month's worth of implied volatility before we got any data points. And, I went out on a small limb and said that I thought we'd probably see lower from that particular price, as is often the case once the actual calculation starts to kick in. So we've gone a week now, and we actually saw 1041, so it was lower by almost a full point. That was last night's settlement. But we have an interesting phenomenon brewing. We've seen it before, and it's something to keep your eye on. The first week of volatility in the euro has actually produced a calculation of realized volatility of 7.93. Now, that's the actual volatility of the instrument. Meanwhile, the 1041 reflects that the portion, sometimes we refer to it as the stub, or the implied or inferred volatility that's left, is up at about 1084. So you've got almost a 3-point premium between the two, and obviously that's got to shake out over the remaining days when we see whether the prevailing realized volatility takes hold or whether the underlying instrument starts to reflect the greater volatility that is inherent in that 1084 inferred piece. So we'll keep an eye on that, maybe talk about it a little later in the crystal ball section.
That reminds me of the disparities we saw when you first launched that Euro Vol contract last year, and we saw these ridiculous numbers coming out of the implied land and the realized vol being dramatically lower. And, of course, those two eventually had to come together. It was quite the feeling out process, and it is surprising to see that level of disparity with such a small amount of time remaining in these contracts.
Well, you're right, and we do recall that in the earlier days, and again, I think one reason for it is something that Mark, Sebastian, and I discussed last week when we talked about the very big disconnect at the moment between VIX futures levels and the actual realized volatility of the underlying cash. And so when you have that, it can shake out in different ways. Some people say, one's got to go up. The other says the other has to come down. And chances are they might actually meet in the middle somewhere, where the realized volatility of the euro might be awfully low and might rise a little bit, but where the actual price of the contract might actually drop and they meet halfway in between.
Well, we'll certainly be watching for that, and perhaps we'll get into a little bit more detail in the crystal ball. about just how those contracts may diverge. And of course, here on Volatility Views, we do cover the broad gamut of volatility and volatility products, including that ever-popular S&P volatility, a.k.a. the fair gauge, a.k.a. the VIX. And Mr. Sebastian, I gave you a little bit extra time this week to mull over what you saw going on in the week's worth of volatility actions.
Well, we actually saw a major break in correlation this week that we hadn't seen since, basically coming when we were about to rally. We hadn't seen a major VIX S&P correlation break in some time, and then we saw that this week as the S&Ps rallied and the VIX rallied at the same time. Then today we've got the S&Ps down, and I think they are going to go lower this afternoon, and you've got a major kind of uprising in Greece, a potential shocker, Greece default. The VIX has overreacted today's down move, and there's a lot of people buying insurance over the weekend, so when you're listening to this, the news will be out. One of the things I'm going to be watching is not today's VIX, but if the Greeks get everything done on Monday and the VIX does not collapse, I will be taking off every single short vol position. So going into this evening, I will probably be entering some short volatility trades. If we come in on Monday and there's a Greek deal done, and the VIX does not sell out, does not sell off, that is going to bode very, very poorly for there's something else going on, is basically what it means. What that is, I still can't figure out. There's something creepy going on.
The unknown unknown is always very scary.
Yeah, there is an unknown unknown. The last time this happened was when we found out the S&P was downgrading the United States after the fact, and it already leaked it out to a few people. We don't see something like that happening on Monday, assuming this Greek deal is done. As you're listening to this, you go, oh, look, the Wall Street Journal says the Greek deal got done over the weekend. And then you're looking at the market, and it's up some, but the VIX is flat to up, something. There's something else going on. So that's kind of what I'm watching. I don't know. Henry, you seen anything similar to that? You kind of along the same line as me?
We saw there was a decent spike. The busiest day this week was the 7th. It was at Tuesday, and it was March 35s. So VIX was at 17 something, and big sellers like blocks of 10,000. 150,000 on the day traded, and some of the most of the prints were in like the 30-40 cent range. I think the VWAP on the day was 41 cents. Most of the shows that I see for that is paper selling. The vol of that contract on the day was down a couple points. So, it is kind of I think it might have been an early time to start selling out some VIX calls. But that's the way it was leaning.
Yeah, that's pretty aggressive.
Today's the day to be doing it. We've seen a huge pop. VIX option implied volatility is up about 10 handles today. So if you were planning on selling any volatility, today is the day to do it.
Every day is the day to do it.
Oh, Don, that's just not true. And you know it. All right. Take Apple. When Apple vol got to 18, it was the buy of the year. And look what's happened to the vol. It's almost doubled now. So even you will admit that there are periods of time where one would consider
not selling volatility.
Maybe not buying, but you're not going to sell it, is what you're saying.
Right.
So
you just have to make sure you have deep pockets. That's all.
Well, it is interesting to see all this size paper flow coming into the VIX. Sounds like people are still leaning to the dark side for the time being. But you're right. We've discussed on the show many times in the past few weeks how low can that limbo pole go in the VIX, and there definitely could be a few more notches, but the potential for that pole to explode to the upside is lurking out there. And I agree with you that I think if you're putting on a significant short positions, particularly if you're writing hundreds of thousands of upside VIX calls, then like that customer was, or those many customers were, then hopefully you have some other hedge to offset that in case that unknown known becomes a known over the coming weeks.
Exactly.
All right, and that is going to do it for the volatility review. And now we're going to dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
right, that festive, almost tropical music means it's time yet again for the Volatility Viewpoint, and this week's guest / victim is, of course, Henry Schwartz, the major domo over there at Trade Alert. And we wanted to bring Henry on the show this week because we've had an ongoing discussion on this program. If you listen to Volatility Views at all since we've launched this show, we've delved many times into the world of VIX and VIX settlement and the possibility, in fact, the conspiracy theory that has been floating around quite a bit over the past few years, that settlement can be manipulated in some way, shape, or form. So we wanted to bring Henry on the show because many times in the past when we discussed this topic, it's been primarily on a theoretical basis. You could do this with this, you could do this with that. But Henry, as we said, is the man with the data. He's the one who has the smoking guns, if you will, for what has been going on in the land of VIX and the land of options. So we thought he would be a good guest today to come in and shed some light on this very, very controversial topic. So, Henry, we gave you an easy one today, so don't worry. There won't be any mail on this topic whatsoever, so I don't think anyone's listening either.
No.
I just appreciate it's not okay, calculate the VIX based on these numbers. And
We've certainly done our fair share of that in recent shows, but now we're diving into something a wee bit more practical for some of our listeners. I think before we do that, before we dive into that practical element, since we have talked about it before, but we have a number of new listeners, I guess we'll do a quick overview of exactly what we're talking about when we're talking about VIX and the potential for it to be manipulated. Of course, VIX futures and options are cash settled, and they are settled on a Wednesday morning, and that process is guided or inferred by what is known as a special opening rotation of SPX options. That's where they go through the strikes, all the strikes that are listed and trading, and either look for orders resting in the book, or they look at a average of the bid ask to determine the value of those options. And people have claimed for a long time now that process can be used to manipulate the ultimate settlement point of VIX. And you can imagine these are cash-settled products, so that ultimate settlement point can have a great deal of impact in determining the ultimate value of your position going into settlement. So been a lot of talk about this. Henry, I know you and I have discussed this many times, going back years now, in a variety of areas, looking at different trades that may be potentially. But, before we even get into some of the specifics, let's talk at the 10,000 foot level. Let's start there. What is your viewpoint on this whole VIX manipulation? Some call it truth, some call it conspiracy theory. Where do you fall on that spectrum?
It's the timing is very funny because a friend had asked me. He was actually interested in starting to trade some VIX at the fund that he's at, and this was in December, and he said right after that 21st settlement, he said something was really weird. Can you ask around? And I have the kind of the luck to deal with traders at a whole bunch of different firms, and I was at a bank that afternoon, and I found the guys that trade VIX, and they're always French quants basically. This guy
certainly seems to be the way. And when I was out in the S, all the people on the other end of the phone always had a French accent for whatever reason.
Yeah, the volatility traders they're 97% have to be French. But I asked this guy, I said, oui. And so I said, hey, was there anything weird about that? And there were two guys, and they both kind of laughed. And I said, okay, well, was it like, criminal weird, or just kind of, these things happen? And one guy said it was criminal, and the other guy said it's just part of the characteristics of that product. I think that's kind of the reality is, it's not really that different from, remember they used to, print up SPX settlement, by 10, 12, 14 points every once in a while.
What do you mean used to?
It's not nearly as extreme as it was.
Right. No, that's true.
Because I think you have too many. They run into all these, high frequency traders that take advantage of the prices that get out of line. So basically, it's very hard to get the prices out of line. Whereas 10 years ago you could do it because the high frequency guys weren't quite as fast. But so traders are always going to look for the loophole. And when this guy said it's part of the characteristics of the product, that's the reality. Is it's definitely manipulable, but that's not against the the rules of the whole thing. I mean, when SIBO created the product, they came up with this settlement methodology. The whole point was basically just to let people with options and futures positions settle into the same number, so you didn't have any sort of weird mismatch that could cost you money. The same way that SPX quarterly options expire and SPX futures all expire into the same value. It has to match up, or there's all sorts of additional risks to trading it. The whole point of the settlement is, it's better to use trades than to use mid-market quotes on $2 and $3 and $4 wide options. But you have the same issue. If somebody's willing to, really sell a decent, enough of the entire strip or kind of strategic parts of the strip, you're going to get a lower settlement print because it is a it's just a calculation. The reality is I don't think it's really that easy because you have to have some decent balls to say, okay, well, you know what, I'm going to sell, all 14 of these strikes because it's going to, I'll pick up an extra half a vol point in the settlement because there could be somebody on the other side that's going the other way twice as big as you are. So I don't think it's just a simple matter of they can do it, so they do it, but I do think it's part of the way that product works.
And Henry, you and I, like we said, have talked numerous times about this prospect of VIX manipulation in the past. I recall several times sitting down with you looking at sizable prints going up in a lot of these products, and we should outline for our listeners exactly what the typical strategy people use to manipulate or quote-unquote manipulate the VIX is or has been in the past is because, we talked on the show many times about the way the VIX calculation squares the strike price. The lower you go on that strike chain, the more influential those puts become from a vol and from a VIX calculation perspective. So people are quite often putting bids in extremely beyond worthless puts, S&P 500 and below type puts, in order to put a bid in that product, which will then translate into a ridiculous vol level, which will then translate into a ridiculous or inflated VIX settlement print. That's typically what we see is action in that downside SPX put wing. That really seems to be the bulk of the action. And I know you and I have looked in the past, I think the last time we did this was a couple of years ago, where people were actually putting sizable amounts of money, many hundreds of thousands of dollars, into at least an attempt to generate some sort of corresponding movement in the VIX settlement. So that seemed to be de rigueur a couple of years ago. Are you still seeing that size amount of allocations toward this strategy, or has it somewhat tapered off of late?
No, you still see. I mean, we do count the contracts, and it ranges from about 150,000 to like 250,000 total contracts. They're all printing in that Haas settlement. You can actually, SIBO keeps those spreadsheets around, so you can go and add them all up, and it's the numbers are pretty massive. It is the strategy is the same, but it's funny because if like right now the farthest out of the money February put that has a bid is the 1090 strike. Okay, index is at 1300. When they print that settlement strip, they always print options at a nickel all the way down to about the 600 or the 500 strike, and they all trade for a nickel. So if you think about it, it doesn't make any sense, right? That the 700 strikes, somebody's willing to pay a nickel for it, and the 900 strike, somebody's also willing to pay a nickel for. That
Exactly.
implies that 200-point put spread is free, or is worth zero, and obviously it's got some positive value to it. But the thing is depending on what the strategy that the trader's trying to replicate, it's not always a matter of closing everything down. Sometimes they're trying to keep a position on. So if you have a VIX future that's expiring and you don't want it to expire and you haven't rolled it, you can turn it into this strip. You do need at least the French quants I've talked to have said, oh no, I need to buy every strike. I can't double up and buy twice as many 900 puts because for me to perfectly replicate the hedge that I need, I do need the strip all the way down to, you think about it, an option that's no bid at a nickel could be worth 2 cents, it could be worth zero. So, the value stops somewhere along that somewhere between 900 and 700, I guess you get to zero. But, so it's the reality is it's very hard to differentiate between some intentional manipulation to get the print to go the direction that they want and somebody that needs to do what they want to do.
Henry, correct me if I'm wrong, but my understanding of the actual mechanism that calculates VIX and what strikes are or are not included has to do with two things. The first is that if there's a zero bid for any option, then it doesn't get included in the calculation. The other part that's important is that if there is such a bid, but if above it at a higher strike there's a zero bid, then everything below that zero bid gets dropped as well. So in the case that I just mentioned, the one that had a bid wouldn't be counted because something above it had zero. But now you actually discussed two different concepts in what you just were talking about. You were talking about a replicating strategy where you have to have all of the options and in the correct amounts, equal weightings in order to try to replicate through options what an actual VIX index would be. But separate from that idea could be that you would have an enormous position and possibly an unhedged one, an enormous position in VIX futures and simply want to manipulate that closing price. And let's just say, for argument's sake, say you long the futures and you want to get a higher price at the settlement and manipulate. Now we're not talking as much about having huge positions or allocating a great amount of money to any of those out of the money puts. We're talking about putting in one lot, single bids in as many as you need all the way down so that there are no zeros above, simply to get all of them to count in the calculation. We're not talking about a hedge for the futures. We're not talking about hundreds or thousands of these options. We're talking about a single option all the way down the strip so that they all count in the calculation for the settlement price, and then you're long futures contracts, perhaps in an enormous position.
Right, which is I guess it's definitely possible. I think that when we watch it, we've never seen prints less than a couple thousand in all those nickel puts. I mean, looking at the December one, which is kind of the one that a lot of people are very interested in, the lowest strike that printed was the 820, and there were 2,100 of those. So you're right that basically you could. I mean, somebody could put a nickel bid in the 100 strike put. I mean, there are 100 strike puts in SPX in February. That I'm not seeing. I see enough size that it actually looks like it's more replication than manipulation. Although, like I said, the guys that I was talking to said there are people that are playing some games, but I think they're actually playing the games more for the near the money options, not this super far out of the money stuff.
Okay, well, I mean, there's the practical aspect. I take you at your word. You study these markets, so you're reporting what happens. And, I have no qualm with that whatsoever. But I just wanted to point out that the actual mechanism for the potential for manipulation doesn't necessarily require that you take these large positions in the out of the monies. And again, I'm talking more theoretically as to what could be, as to whether it happens or not. But from the theoretical standpoint, the ability to get each one of these options to be included in the calculation and therefore to, in essence, manipulate a price would simply suffice to have a single bid of a one lot in each one of these, tremendously far out of the money options in an effort to get them all to count.
Right. No, that's definitely true, and that kind of leads into the other thing that I discovered after I started digging around a little bit more, especially in this December print, because it was the settlement value. Everybody looked at it; it looked like it was a solid point or more below kind of where everybody thought it was. And so the other issue with settlement is this whole strip needs to net out at one price. Each option needs to net out at a price. So as they're putting out these, it's kind of an imbalance. It's interesting to watch. At the next VIX settlement, you should go to the webpage because it's very cool. You see, okay, these options are going to open at 30 cents. Okay, no, now they're going to open at 35 cents. Okay, now they're going to open at 40 cents, and then it comes back to 30 cents. And it's basically, I think they refresh it every 30 seconds or every minute. But one of the criteria for this is, if you have 1,000 at-the-money calls that are going to print as part of the settlement print, they all need to net at a price, meaning and this is what happened in December, is there were a few strikes where the selling order size was bigger than the buying order size. And, so their algorithm's looking for the net price that's going to let everything execute. And basically in a couple of strikes that were near the money and therefore had plenty of power to move the index, they were short by about 50 contracts on the buy side. But the price that it had to net out at was a couple dollars below where it would have been if somebody had shown up to bid for the last 50. So even though, maybe 1,300 of the at-the-money calls were going to trade for $12, $13 because that was the right price, there were only bids. Basically, you had to go so deep into the book, and the book was so thin that they ended up printing them around $9. And that's actually, for December specifically, that's what did it. And kind of that's why the SIBO pretty quickly after put out their little change to cap the range. I actually couldn't find the circular myself. I believe it's a $2 maximum deviation from the best bid now. There was no limit before. It could have printed an option worth $20 at $3 if there was enough sellers and no buyers. And that they're saying won't happen anymore.
Yeah, I was talking to some SIBO guys because that December settlement got quite a few hackles up because it was so surprisingly low. And their off the record kind of behind the scenes explanation was that there was a size resting order in the book that they apparently no one noticed, and that was really what contributed to that was at least their claim. That's what contributed to that dramatically lower December print. Maybe.
Well, but that's the thing that kind of really harms the credibility of the product, and
exactly
that's what's made people very nervous. Is like, well, gee, the thing's been listed for a few years, and it's really busy now. I mean, you have a few 100,000 contracts a day trading. There's a ton of money in VIX options and VIX futures, and for the actual the foundation of the whole thing, which is the settlement valuation, to kind of be subject to some little like, oh, well, by the way, this can happen, it makes people very nervous.
It is amazing that the perception out there is so rife, and it is a huge problem. You're right, for the folks over at SIBO. They really need to confront this. I mean, just type VIX settlement into Google and see what you find. For every white paper you see on how it's calculated, you'll see 2 or 3 blogs or links or papers decrying some sort of manipulation or giving you specific examples. There's even a term for it. They call it carpet bombing, where they pick up all those SPX out of the money puts, and just a lot of very bad perception. And the fact that you're right, this settlement process still, for as mature as this product is still a relative crapshoot.
Yeah, I mean, it's nuts. I mean, I don't understand why they would use an opening like a Haas as opposed to just the kind of standard VIX calculation for it. I mean, it is the entire process of settlement is nuts. It makes zero sense to me. I don't get it.
I, as someone who sat through a number of those opening rotations in SPX, I know how garbage they are. They're just terrible. And to base the settlement of another product off of that is a flawed, I think, process in and of itself.
Sounds to me like somebody ought to come up with an alternative product that's has a transparent settlement price that can't be manipulated and that's actually settled to a formula. That would be a good idea.
Oh, Don, so subtle you are. But, Henry, then just to kind of summarize what you just mentioned there, you're saying that in terms of the data you're seeing day to day or month to month coming into the VIX, you are seeing a size amount of contracts being devoted to these quote unquote out of the money type worthless options that, just by their definition, because there's so many of them, will amount to many hundreds of $1,000s, if not more, in terms of, like, if they're printing at a nickel, then much more. But you're seeing that's more of a replication strategy than really a direct attempt, in your opinion, to manipulate the settlement of the VIX, and that you see what activity you do see that is more perhaps manipulative in nature is actually closer to at the money. Is that pretty much what you're seeing?
Yeah, that's what I've seen. And the other thing that I think Sebastian kind of hit it on the head is why why do you have a structure where you can get such a different? It's an unrealistic settlement, even though it's a decent kind of methodology. It's not the same as where the VIX really is. So why are you trading something that's going to settle into basically something different? The other thing they have SPX PM now, that has markets on the screen that are 50 cents wide instead of $2 wide for the same exact option. So I wouldn't be surprised if maybe somebody said, well, gee, why don't we just calculate it off of the PM? Because the PM is basically a little bit more of an efficient market because it's more competitive and it's anonymous. The SPX has its kinks because it's not anonymous. It's still a physical crowd. And, there's things that go along with that, that are not so transparent and are not so efficient. And that's the risk with that product. I mean, I would think anybody that's really, kind of trading and doesn't want to have that risk, I guess you have to roll everything. You never should be going into an expiration with a futures position on. That's for sure.
Yeah, that's definitely, regardless of where you fall on this debate, whether it's manipulated or not, that's definitely the takeaway from this conversation, is that you can't allow yourself to be exposed to that kind of risk around settlement time. You can't have the dice roll and let that determine what your ultimate position is going to be. You have to roll it off or close it out ahead of settlement. It's too much naked exposure for absolutely no reason at this point.
Right. Well, and that's why, SPX and VIX both, they're not, they are for the big boys. They're not retail, and, normal people have no business trying to touch those products. SPX PM maybe, because it's a little bit, you still get the big contract size. I get what they're going for there. But VIX and SPX are professional level products that, that are tough enough for people whose, full-time focus is trading them to make any money at.
Well,
and they're dangerous.
I think one of the interesting things is how little the professional world understands VIX. And so the flip side of that argument would be that, I understand if I can figure out VIX and kind of how to trade it, I'm even ahead of most of the pros.
Oh, yeah, it's definitely a specialty. I mean, even within the banks that trade, 1 million, 2 million contracts a day, there is usually one or two guys, they're usually French, that understand the product, and therefore I think you're right, Mark. There is opportunity there. If you can figure it out, there's probably some edge or some juice in there that isn't really being taken out, because they're not the most efficient products. That's for sure. But they are probably the most complicated, and that's the other side.
Well, yeah, they got Dominic is having a field day down there. I can tell you that much.
Good old Dominic. But, you see the numbers, Henry. I mean, you probably know more than any of us just how much of a success VIX has been from a retail perspective. I think that's been kind of the surprise, I know, to the people who created it, that this would even have any penetration in the retail sector. And yet, in many ways, the story of VIX over the past few years has been the retail adoption of VIX. And yet, you're right, it is a completely obtuse, completely bizarre product that most of them really can't wrap their heads around. Yet, we're seeing tons of retail numbers. I mean, I'm sure, do you have any data on lately about what would you think would be, retail customer versus big institutional going up in VIX?
That's a good question. I mean, it's funny, I guess retail's probably attracted because there's enough sophisticated retail that likes this, the concept of mean reversion, which, it does work for VIX. It doesn't work for Apple stock or something. So there's some people that like to play that. I didn't run numbers to see kind of the percentage of VIX that's one lots or two lots, but it's tricky. I mean, there were a lot of stories a few years ago about customers putting on these calendar spreads for credit. Remember, and the brokers were actually letting them because it was a calendar spread, and on a normal product, a calendar spread can't be worth less than zero. So if you can buy a December option, for $1 and sell the front month option for $1.10, that was an automatic winner. And some brokerage firms and clearing firms got dinged because obviously with the way that the VIX futures term structure is actually what you're trading there, that ARB doesn't hold.
And now, Henry, you mentioned just to summarize then, on a wrap up on this whole VIX manipulation conversation before we dive into the crystal ball. You did mention something interesting as well. You said you're seeing any if you do see funds being allocated towards anything that would be quote-unquote manipulation, it is closer to the ATM. Why don't you delve into that a little bit for us? Because that is, by definition, a much riskier and much more expensive way to attempt to do this. So what in particular are you seeing on that front?
Well, I mean, what I'm saying is when I looked at the December 21st print, it wasn't the nickel options out to the 600 strike that looked fishy. It was these at-the-money options trading multiple dollars away from what the value was. So I think that it's that just seems to be where, I suppose if you're gonna play in a nickel option, if it's one thing to try to trade a 1 lot or a 10 lot to move the price, but when you're seeing a few thousand trade, that's not somebody moving the price. It's somebody that for whatever reason wants that position. It's the front term it's the at the monies that when they're trading are sometimes trading out of whack, and that's the fact that those aren't kind of trading at where they should versus where the options are really going to open up or be trading 10 seconds later is what looks to me kind of fishy.
All right, so speaking more to the specifics of the DEES settlement than ongoing. Speaking of settlement, we saw a lot of consternation over January's price as well. DEES was supposedly far too low, and January was, of course, far too high. Did you have any? Did you do any digging into the January settlement as well?
I did. I have them right in front of me actually. There's it's a weird strip of options, right? Like I said, not only do you get the 700 put trading for a nickel, and you can also get the 800 put trading for the nickel. I mean, I see the 740s trading for 15 cents, but the 750s trading for a dime. So that put spread traded inverted, for a nickel credit. Whether or not it's hard to say if that's somebody who knew by paying up a nickel at the further out strike that they'd be able to pop the number higher. It's very possible. I guess the real in the end, it's very hard to differentiate between somebody who's putting money into it purely to get the print to move half a point or a point, and somebody who is basically putting a market order out there so that they can get the size, the strip that they need. And when I look at the numbers, there's enough volume. Even 7,000 of the Feb 675 puts traded at a nickel. That's not a 1 lot. And I think it's hard to say that somebody wanted to actually go spend that kind of money just to move a price around. Because you own those forever. It's not like you're selling them back out.
Yeah, not exactly many buyers to turn around to dump those Feb puts. Well, you said 675 puts?
675, 7,700 for a nickel.
There you go. There's your at least you can say dubious volume. We'll have to talk to more of your French compatriots there to see exactly which they seem to know which parts of the strip and where to allocate their funds to have the most bang for their buck.
Well, and then the other question is, and this data I haven't looked at, but the size of the print should be somewhat related to the amount of VIX futures open interest there is. So because if it really is kind of an offset, then they should kind of wash out. You shouldn't see the option print equivalent to 20,000 VIX futures if there were only 6,000 VIX futures expiring on that date. So that's another thing that we can look at and try to figure out, like, okay, why is this 6 times as big as the VIX futures open interest if the whole point is basically to let people with expiring VIX futures, get out of their position with no risk to the mark.
Yeah, interesting. So then the numbers also get out of whack in that sense as well. And then, of course, if you type in VIX settlement or VIX manipulation into Google, you will go on a very wild ride. I recommend it to anyone who wants to go down that dark path. But, of course, they also bring up a number of specific dates where there was supposed size manipulation. I think October 2008 is a very popular one bandied about. We see May of, 2011 of last year. People were also very dubious of the DEES of last year as well. So a lot of specific dates that people kind of come up with that are supposed evidence of this of size manipulation going on. But I think what we've seen, and like I said, you and I have talked about this in the past, going back several years now. People are allocating funds to these parts of the wing. Like, for example, the amount you just mentioned, that was about $35,000 someone threw at those puts for we don't know what purpose. So there is still interesting, if not dubious, volume going up across the board in the VIX, as well as on the settlement days, some of these futures trading at, or the options trading at, bizarre prices, even closer to the at the money. That probably, like you said, has a little bit more bang for the buck than the OTM puts. But still, I think at the end of the day, the moral of the story is there still is a lot of dubious activity going on out there. To what end this stuff is being cooked up and implemented, I don't think we can definitively say, hey, bam, this is manipulation. This person spent $35,000 on these Feb 675 puts, and he got this much bang for the buck out of the settlement. Settlement was higher than it should have been. Maybe that 7,000 lot contributed to it. But I don't know yet. It's hard to. It's the old excuse they used to get whenever we'd see these crazy puts or these crazy trades going up on the Cboe floor at 259 and some big house is coming in to buy 10,000 upside calls and let's say Intel. The excuse was obviously that's dubious behavior, but then of course the old excuse was you can't trace it to an account who then shows intent and blah, 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 blah. And I think there's a lot of that vague stuff going on here in VIX realm, but certainly is a lot of interesting activity. So I guess moral of the story is that it's let's just say, shall we say highly dubious and leave it at that, Henry? Would you agree with that?
I would say some manipulation goes on, but it's buried, and it's very hard to pinpoint.
Yeah, well, you are the man with the data, so I would trust your analysis on this. Don or Mark, you have anything else before we close out the great VIX manipulation discussion of 2012, at least for this month?
I would just repeat something that I said earlier, because I think it's probably true, and that is if you've got somebody who's buying thousands of 600 strike at a nickel, again, it doesn't mean that there's any bid for those options. So the transaction may go down and the buyer may lift the entirety of the offer of anybody out there willing to sell at a nickel and not thinking that he's taking too much of a risk. But if the bid remains zero, then once again, those options are not counted in the calculation of the VIX. So it's very questionable there as to whether or not such activity would actually take the form of price manipulation as opposed to somebody who's trying to actually replicate an index value and who then might want to own these particular options because they are needed, as Mark Sebastian said, to offset a futures position. And then it comes full circle to what I was saying earlier. What's the sense in owning all of these and offsetting a futures position if they're not going to count in the calculation in the first place? You don't need them to replicate VIX if they're not a part of VIX. And they're not a part of VIX unless they have a bid and an offer. And so it comes back to the fact that you can buy 1,000 of these if you want, but if there's not a bid for a one lot of that particular option on the day that the index is disseminated, it's not going to count in the calculation of the index. So it kind of comes full circle to what I'm saying. These are two different activities. And in order to actually complete what, you might call a manipulation of the VIX index settlement price, you need to have at least a one lot as a bid in all of the strikes, not only down way below the market, but above them as well, so that there are no zero bids, or else none of those options count. So, it's a little bit more complicated than perhaps just, somebody coming in and buying options.
Yeah, that's true. I'm assuming those 675 puts weren't cabinet or nickel bid coming out after that trade. I'm sure there were still size offered at a nickel, and I didn't see the print, but I'm assuming there wasn't a cab bid coming out for those either.
And, that also kind of responds to Henry's point about, inverted spreads and doing a put spread for a credit, which, shouldn't be possible, whereas it hardly matters down at those particular levels. We're not going to get there. And you say, I get a put spread on for free. Once again, you really don't, because there are no bids. It really doesn't matter if the lower one is 10 cents and the upper one is 5 cents, and you say that shouldn't be. Well, go ahead and buy the one for 5 cents and now go to the one that's 10 cents and try to sell it. it's offered there, but you can't sell it there. You're still selling it with a zero bid. So, you're not establishing that put spread. Looks good on paper, but you can't trade it that way.
All right, Mr. Schwartz, thank you for chiming in on this very heated and contentious discussion. I'm sure a lot of people out there right now are banging their tables and saying, why won't they confirm that VIX is manipulated, and why won't they go down that road? I'm sure some people will say we came to a middle-of-the-road conclusion, but that's what the data supports, at least for now. But an interesting discussion, and one I'm sure we'll definitely revisit down the road again here on Volatility Views. But now we're going to close out the old Volatility Viewpoint and dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and those soothing, somewhat haunting tones mean it's time for the Crystal Ball segment. This is where we peer deep into the murky ether of the future and attempt to divine what the world holds in store for us from a volatility perspective. And Mr. Sebastian, since we let Don go first on the old Vol Review, we'll let you lead off this time here in the crystal ball. I have a feeling I know what you're going to say. Short VIX going into the weekend, and then watch out for that unknown that could be lurking on the horizon.
Exactly. I that's exactly what I'm going to say, believe it or not. So, I mean, that's exactly what I think, is that, I think this Greek stuff's a little overdone. I think the market's probably a buy here. I think we're going to close on the lows of the day. It's going to give you an excellent opportunity to kind of swoop in and buy. Puts on VXX might make some sense, because the futures, the term structure hasn't moved very much. It's only been the actual volatility that's gone up. So that's kind of something to remember. So yeah, I think we're going to close in the lows today. I'm probably going to go out short vol, sometime after 2 o'clock today. So that's my plan.
Wait till the end, then get short with the Seabass. Mr. Schwartz, you have anything to add on the VIX outlook?
No, I think things got a little bit too cheap, and I actually think we'll hang out between 20 and 24 for a little while. I just think, we had such a mellow run up where everything was so right in the world that we're due for a little bit of turbulence. I guess I'm also kind of hopeful for that because the option volume has been pretty light, and we've talked about it before. Like there's VIX at 45 scares people out, but VIX at 16 also scares people out because there's just nothing going on, and it usually means the market's just going up, and there's no reason to really do anything except just be long.
Right.
Yeah, the good old VIX at both ends of the spectrum is a bit of a dangerous beast. And Mr. Schlesinger, what say you, sir, regarding the future of Eurovol? Of course, we have that divergence that is coming into play in the coming days, the stub days, as it were, of those vol contracts. So
yeah, so I'll make a shaky prediction for a little bit lower, only because the realized has seemingly set into a pattern, which of course can change at any moment, but we're starting to see that equity-like characteristic where, although the euro is off today, it had hit about 133 earlier in the week. And so we saw an orderly increase that was leading to very low volatility. So with the realized portion under 8 and with the forecast portion, if you will, close to 11, then I'll take a stab at going a little bit lower for the coming week.
Sold to you. Shocker.
Okay.
Yeah, I think when you look at those two of the whether realized will pop or the implied will sell off yet again, I think you have to take the latter of those two. That seems to be definitely the more sane bet of those two, at least for the final days of that contract. All right, that's going to do it for the crystal ball portion of the show. That's also going to do it for this episode of Volatility Views. I, of course, want to thank our guest, Mr. Henry Schwartz, the CEO, the founder, the major domo over there at Trade Alert, as well as whatstrading.com and his new upcoming website. I won't mention it. I'll leave it to you to mention if you want to mention it or not, your new upcoming ventures. But Henry, why don't you tell our listeners where they could find more information about Trade Alert as well as some of your other entities?
Yeah, we've somehow morphed into three pieces. Well, Trade Alert is our institutional service, and you can find us at tradealert.com. Whatstrading.com is a slightly simplified version of the information that's designed for retail to help them understand what's trading. And the latest thing that we just started is actually called optimalx.com, which is a very simple and free site to help option traders see exactly what in-the-money calls are subject to optimal exercise based on pending dividends. And the site kind of lays out the information nice and easy. We're gonna support email alerts, but what's kind of neat is we quantify the exact dollar amounts that are at stake, and it can be big. I mean, today there's $5 million of dividends that will be captured by people that exercise, and so you'll see this massive Philly volume, especially in Seagate and Valero, and you'll see millions of contracts trade. But what's really very cool is of the $5 million that's up for exercise, about 10 or 15% won't get exercised. So we actually show on the next day how much was left and how much the Philly traders, basically, or the people doing the strategy there, managed to collect. And that's why.
Yeah, because the Philly, through the commission limit, basically hijacked the market maker play. So now you've got a bunch of upstairs institutionals just doing thousands and thousands and thousands and thousands of contracts for basically nothing. It's the biggest load of hooey on the planet. That the Philly did this, I think, is borderline scandalous. I mean, I can't stand the Philix. I mean, what a load of crap.
So tell us how you really feel, Mr. Sebastian. This episode from Option Pit brought to you by NASDAQ OMX Philex. But
call them up, see if they want to put a banner.
Yeah. But yeah, I agree, and I've said that to the boys over at Philex and Tom Whitman many times. Why do they attract that kind of volume? And Henry, I think your new service is an interesting one because it does lay out the exact cost and what's being left on the table, and that's kind of the unsung story of the div trade phenomenon, is how much is being left on the table, how much retail is being impacted.
That's exactly it. I mean, customers are the thing with the dividend volume. Depending on who you talk to, it's perfectly legitimate or it's scandalous. But the reality is there are customers that either because they don't know or they forget or they can't exercise are losing money. And if everything gets exercised, that Philly volume will dry up because there's no reason to do it if the exercise ratio is going to be 100%. So that's kind of what we're kind of going at is, if you educate the people that have these calls, if you're listening, well, you're not going to be listening before you have a chance to exercise your Valero call tonight. But if you forgot, you're screwed. And you can actually quantify exactly how much you just lost. And that's what we're kind of trying to clarify for people, because it's complicated, but it's not impossible to do.
And listeners, if you want to check that out, you go to Optimal, OPTIMAL, and then XEX.com, and you can see all of the outstanding dividend trades that are going up right now and how much is being left on the table. I'm sure a lot of people will be interested in that, including our friends over at the ISC who have a bone to pick on the dividend side of the spectrum. And Mr. Sebastian, what is coming up in the land of Option Pit? I believe a little birdie told me you have an upcoming webinar.
I got a webinar I got a couple of webinars on the 15th coming up. Hey, keep a lookout for an email from Option Insider and Option Pit, where we're going to send you Andrew Giovinazzi of Option Block fame wrote a really great ebook on synthetics, and it's probably the best explanation of synthetics I've actually seen out there. And I think we're gonna. Little Birdie told me that you and I are gonna work a way to get that out to your customers.
Yeah, we can get that out there for free for the listeners, so they can have some access to Andrew's wit and wisdom.
Which is plentiful.
Yes.
The guy knows his stuff. I will tell you that.
If you listen to Option Block, then you know Andrew is wit and wisdom is indeed plentiful.
Yeah.
And
Fewer 80s references and Ferris Bueller jokes, more knowledge. That's what I would say.
Yes, he's much lower on the uncomfortable analogy spectrum as well, which I find quite pleasant to to say the least. And of course, last but not least, Mr. Schlesinger, the man holding down the fort over at volex.us. What is coming up in the land of volex.us that may interest or intrigue or perhaps even titillate our listeners?
Well, two quick reminders. We had Simon Ackham on last week from London Financial Studies. Don't forget that extremely valuable workshop and seminar that they will be giving in New York City in the middle of May, the 14th to the 16th, and a 15% discount on the tuition for that to our Volex viewers and those who go to the website and our listeners here on the show. Also, we now have a mobile phone app for all of our indices. So they are now available on your handheld device if you just type in m for mobile.volex.us, and you can now bring up all of the historical volatility indices and all of the volatility of volatility indices very clearly and easily arrayed for a smartphone or for whatever you're using. Just m.volex.us, so you can have reference to all of these historical indices on the go.
Great. So you have a mobile version of the site now, so many of our listeners who are listening or who are looking at these sites while they're on their phones can access all of that fun data from their phone. So that's a nice change to see coming up on the volex.us website. And of course, listeners, if you want to listen to previous episodes of Vol Views as well as any of the other programs on the Options Insider Radio Network, as well as much of the content we discussed today and other topics, then surf on over to theoptionsinsider.com. You can find it all there: breaking news, analysis, unusual activity, radio, the whole 9 yards. If you're interested in options, chances are there's something there that may pique your interest. And of course, we want to thank all of you out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.